Welcome to the FMLS Market Intel Report. I'm Leslie Appleton Young, FMLS Chief Economist. It's hard not to be a bit overwhelmed by the strength of economic headwinds roiling the markets. From Wall Street to Main Street, there is a sense that the best strategy is to wait it out, taking a pause on big decisions like hiring new employees, investing in new equipment, and buying a home. We are seeing this play out in consumer spending. Retail sales rose by a modest 0.1% in April on the heels of a robust 1.7% gain in March, driven partly by accelerated purchases to beat the new tariffs. We also saw signs of declining discretionary spending as consumers tighten their belts against an unknown future. For housing, this reluctance to commit was in evidence in the April numbers. NAR reported that national home sales in April came in at an annual pace of just 4 million, the lowest total for any April since 2009. This was also 2% below April of last year and down 0.5% from March. This is the second month in a row that we have seen such declines, very unusual for the traditional spring home buying season. There are also more homeowners interested in selling. Inventory continued to rise in April with 1.45 million active listings, a 9% increase from March and 33% higher than a year ago. And there is now a 4.4-month supply of homes on the market, a number not seen since May 2020. Many areas have now reached or even exceeded pre-pandemic levels of inventory as we enter what I'll call balanced market territory. Despite higher inventory and slower sales, prices continue to advance. The April median of $414,000 marks the 22nd consecutive month of home price gains. Noted NAR's chief economist, Lawrence Yun, explained, home sales have been at 75% of normal or pre-pandemic activity for the past 3 years, even with 7 million jobs added to the economy. Pent-up housing demand continues to grow, though not realized. Any meaningful decline in mortgage rates will help release this demand. Unfortunately, rates are not declining. As the 10-year bond increases in response to market fears, mortgage rates are now 6.86%, an increase of 25 basis points in just the past 4 weeks. The biggest rise came with the May 16th announcement that Moody's downgraded the U.S. credit rating, sending the markets an ominous message. Over the last decade, we expect larger deficits as entitlement spending rises while government revenue remains broadly flat. The U.S. fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. As U.S. government debt looked less attractive, investors demanded higher returns to cover the growing risks. U.S. Treasuries have long been a safe haven for investors. Today, questions are being raised. Because mortgage rates typically mirror the 10-year yield's trajectory, this upward movement translated into higher borrowing costs for home buyers. The Mortgage Bankers Associations reported that new and refinance applications both fell 5% for the week. In March, before the new tariffs took effect, pending home sales saw a monthly gain of 6.1%, with the strongest activity in the southern region. We'll be watching the data on pending sales and cancellations closely in the weeks ahead. There are always opportunities in a changing market. Realtor.com noted that for those who are moving forward with their home search, today's slower-paced housing market might feel less stressful. Increased inventory, stable prices, and longer days on the market are making it more likely that a potential buyer will find their dream home and less likely that it will come with a bidding war. Take a look at market intel on the FMLS website to access the most current market statistics. They are updated weekly. If you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this is Leslie Appleton Young. See you next time.